In the last lecture, you understood what is government budget, what are the various objectives of government budget. Now, in this lesson, we are going to classify government budget and understand the various subsections of a budget. Now, there are two major sections of government budget. One is a capital budget and the other one is a revenue budget. Okay. And since these are the budget, we can also again classify them into receipts as well as expenditures. So capital budget can be classified as capital, receipts, and capital expenditure. And similarly, revenue budget can be classified as revenue, receipts, and revenue expenditure. Okay, we are going to explain all of these in details. And let us go to understand the first item of these, which is capital receipt. Now, when you see this, there are two terms visible. One is receipts and the other one is capital. So receipts, you all know, receipts mean when you are receiving something. So when government is receiving the grant or the money in whatever form. So if it is even borrowing, when we borrow, we also receive money, right? Or when we are getting some returns on our investment, that is also a receipt. Okay. And there is another word talking about capital. So when we elaborate it, we are going to write it as those receipts of government which either create a liability or reduce an asset. Okay. By creation of liability, what is creation of a liability and reduction of an asset? For this, we will use an example to understand. So for example, here is a bank. Okay. And there is a person who is a borrower. Okay. Now this particular borrower, when is taking a loan, okay, so this particular borrower is having some receipts, is having receipt, okay, and this particular receipt is creating a liability for him, right? Liability, he has to pay back this loan. So this become a capital receipt because this is a liability for borrower because he has to pay it back. Okay. So this becomes a creation of liability. And when you see it from the bank's point of view, this becomes a reduction. When you now we'll see it from the bank's point of view. So for a bank, when a loan is granted, it becomes an asset. Okay. But now this person decides to pay back his loans. Okay. Repay. So he repays it. So when you look at it from the bank's point of view, this again becomes a capital receipt, and the asset that government has already created now is being reduced. So it becomes reduction of an asset. So see, receipts are being flowing in this direction. First, we have this kind of receipt, and then we have this kind of receipt. This particular receipt calls for creation of a liability, and we see it from the borrower's point of view because he's receiving. And when we see the second receiver, which is bank, this becomes a reduction in asset. So the same analogy can be drawn here. So whenever a government is engaging in borrowing, it is creating a liability for itself, a payment to be made in future. And this borrowing can be both internal. Government can borrow from internal sources from its own public, or it can seek some borrowing from external agencies like IMF, World Bank, and all those, right? And when we talk about reducing of an asset, this particular amount means when government has given some loan and it is recovering it. So it is recovery of loan. Okay. Otherwise, government has various companies running in an economy, right? And when government partakes or sells some of its shares of the companies that is run, then also it again gains some receipt. So we call it sale of share in public sector undertakings. Public sector undertakings. These are the companies run by government. So capital receipts have to be understood in this manner. I hope this point is clear to us. Next, we move on to capital expenditure. Let me